to the church. But let's do this first. Let's all of our in-house participants welcome all of our streaming audience, but just give them a welcome round of applause. We welcome all of those who are streaming. This is a new generation. I get email every Sunday from people who say, Pastor, I was watching you on my phone at the airport. And as old as I am, it's hard to get used to that. People praising God on the runway. But I want to welcome to First Baptist, again, she was here for our 2014 D-Free Financial Freedom Conference, and she and her husband live in New Jersey, and they're just great friends, not just of our church, but they're great friends to the church at large. She has offered her services around this country to churches. She's gone to churches and given out books for free. She has really given back to the community from which he comes, and I just admire that. But she's going to come and do what she does better than anybody in the country. And so fasten your seat belts, pull out your Kleenex just in case you cry a little. But know that you will leave here better than you were when you came here as a consequence of experiencing this profound and this articulate spokesperson for financial freedom. We call her the money coach, Sister Lynette Khalifani-Cox. Come on up, Lynette. Come on, let's welcome her. Thank you.
Appreciate it. Thank you so much for that introduction and for the opportunity to come back. It's always good when you get an invitation to come back, right? Because then you kind of know you did something right that first time around, I tell you, because I know with Reverend Soares, it was a minute before we were able to connect. And he was sharing with me and my husband Earl for so long that I'm going to get you at this D-Free conference. I'm going to get you over there to really talk to people about how to become debt-free, how to better manage your credit, how to do the things that we all need to do, frankly, to get on the road to financial freedom. And, you know, I think he certainly knew my own personal story. And some of you may have also heard that story because I've shared it. And I've been very honest with people about saying that, you know, I was kind of a financial basket case in the past. And that, you know, I'm not proud of it, certainly, but there's certainly no shame in admitting when you've done something wrong and you've learned from it and you've fixed the problem and then you've gotten to the other side. And so I feel like I've kind of lived to tell the tale, and I love to share what I've learned and what I do, not only on a sort of national stage in terms of, you know, TV and workshops and media and all that good stuff, but with folks just like you who are, frankly, folks just like me. So how many of you in here are parents, for example? All right, practically everybody in the room, right? So I have 3 kids. I have a 17-year-old daughter who's about to go off to college. Thank you, Jesus. And I don't say that because I have a child that's a problem child. I say it because I have a wonderful daughter who's amazingly gifted, as I was sharing with some of you earlier, and who's done all the right things, who's done, you know, way more than I could have asked. And I'm super proud and happy for her to be about to spread her wings and sort of fly there. I have a 15-year-old son as well. I have a 9-year-old daughter, Alexis. Where did she go? Did she duck out of the room here? There you go, Alexis. A lot of you will meet her today. So, you know, not only am I sort of folks just like you in the sense that I have a family, I have a wonderfully loving and supportive husband, Earl, who works with me. We co-own together our financial education business. But I'm just like you in the sense that I'm not perfect. You know, I've certainly made my share of mistakes and of, you know, had my share of setbacks, whether that's divorce, because I've been through a divorce. It was emotionally, obviously, traumatic and painful. Somewhat happy in the sense that I was the one who actually wanted to move on, but let's not go there. But it was financially very trying, financially. I've been through a downsizing, and it's not fun. How many of you in here have gotten a pink slip? A couple, 1, 2, 3, 4, 5, yeah. You don't have to be ashamed to admit it. I mean, some of you look like, oh, maybe I shouldn't say that. I don't know. But the point I'm trying to make is that in life, all of us are going to go through setbacks. All of us are going to have our own trials and tribulations. Some of it, when I talk to people about managing their debt and the links that has to credit, I share with them about the dreaded D's: downsizing, divorce, a death in the family of the main breadwinner, disability or disease. Because if any one of those 5 dreaded D's happens to you, it can totally throw your finances out of whack, that's for sure. And for a lot of folks, it causes them to wind up in debt. So I just wanted to sort of set the stage a little bit by saying all of what I'm going to teach you, and we've got about a good 2 hours together. Feel free to ask me questions. Since we are taping, I'm going to ask that you hold your questions until the very end just to make sure that we can get through the program. But I don't want you to feel ashamed or embarrassed or like, I've made so many mistakes, or I'm the only one who's done this kind of boneheaded move. Because trust me, if I share with you, and I am, all of the mistakes that I've made and the problems that I've encountered, you would be like, what? You would have never thought this, okay? So anyway, without further ado, we're going to launch right in and talk about how to achieve perfect credit in 7 steps. And some people ask me, is this really possible? Oh, yes, it is possible. It's sort of like the concept of being debt-free, which certainly members of this church know. We're all about trying to have financial freedom and have a debt-free lifestyle. And a lot of Americans think that it's not even possible. They're like, oh, debt is just a way of life. Of course you have to borrow for college and have student loans. Of course you have to have credit card debt. Of course you need an auto loan. Of course you need a mortgage in order to buy a home. Well, for many people, it may be the case that, you make a choice or that you do incur some debt to finance certain things. But anytime that debt is excessive, is burdensome, you can't pay your bills, you find that it's impacting your credit rating, there's a big problem there. Now, I'm not going to tell you that you should, never use a credit card or don't get a mortgage or something like that. But I am going to tell you that for every choice that you make in terms of your spending and how that aligns with your debt, there's a consequence with regard to your credit. So let me tell you a little bit about my story, since I said that I would, share a little bit. Some of you know that I've written 12 books. One of them is a New York Times bestseller called Zero Debt: The Ultimate Guide to Financial Freedom. So I wrote this book after I got out of $100,000 in credit card debt alone. Okay? I heard you said, wow, right? Whew, wow. Yeah, that was pretty bad. So first off the bat, I don't know who in here has credit card debt. I'm not going to ask you to raise your hand, and I'm not going to put you on blast like that. Probably though, I'm going to just hazard a guess and say probably nobody in here has $100,000 in credit card debt. You might, Nationwide, the average household debt in America is about $10,000. I know from my coaching clients and others, many have $20,000, $30,000, somewhere more than $10,000 in credit card debt. But I got into debt, frankly, because I was a classic overspender. Now, when I wrote Zero Debt, I learned that not everybody, of course, was in debt because of mismanaging of their finances or overspending. A lot of folks like to live what I call the bling bling lifestyle. You know what that is, right? They want to roll around in a nice car, and they want to have the Louis bag and the, and the nice little pumps that are designer name and the jewelry and all of that, and and then go back to their $1,200 a month apartment, right? Okay. Or they want to run up the Visa bill, and that Visa bill is like routinely more than their rent or their mortgage payment every single month, right? So I used to think that people who got into debt, okay, well, they just overspending, they're just mismanaging their money. But no, a lot of people who are deep in debt are actually folks who fallen victim to those circumstances that I mentioned, the dreaded D's: downsizing, divorce, a death in the family of the main breadwinner, disability or disease. So don't just automatically think, oh, somebody's in debt. They could have had medical illness in the family. They could have gotten sick and not been able to work, right? So don't just do the blame game and shame people and just automatically think that the person who's in debt, heavily in credit card debt, who most likely has a problem with their credit as well, because credit and debt are inextricably linked, as I'll show you throughout this presentation. Don't just blame them and think, oh, here's somebody else who wants a bailout. Here's somebody else who's been irresponsible. Here's somebody else who, wants the rest of us to pick up the tab. Blah, 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 blah. It goes on and on, right? In my case, out of those two categories of folks who are in debt, the overspenders and poor money managers versus the folks who have fallen victim to the dreaded D's, I was in the first category. I'm the first to admit it. I was overspending. What were you spending on, Lynette? Whatever I felt like it, okay? I wanted to go to the Caribbean. I was off to the Caribbean. I would put it on my credit card and worry about how to pay for it later. My ex-husband at the time, who was a techie and who loved gadgets, if he wanted a new computer or something, electronics for the house or whatever, just got it. Anything for my kids that they wanted, I just got it. I didn't even think about it. I was just like, oh, okay, well, this is, And even when my children were, my older two children, the ones that are 17 and 15, Alexis obviously wasn't even born yet, even when they were 5 and 3, because I grew up in a household where the mindset was education above all. My parents didn't go to school, but they encouraged their 5 daughters, my sisters and I, to get an education, and it was not an option. It wasn't like, are you going to college? It was, which college will you be attending? Okay? So I grew up with that mindset. As a result, all 5 of us, we did go to college. 3 of us got graduate degrees, et cetera, et cetera. But when my kids were younger, I was like, oh, education above all else. I have to, put them in the best schools, and I have to put them in private schools. So I had my kids when they were 5 and 3 here in New Jersey in $20,000 a year private school. I'm talking kindergarten and preschool, okay? Well, let's not even get to college yet, okay? Preschool, kindergarten. And in my head, I'm like, okay, I'm doing the right thing here because I'm giving them a head start. I'm doing the best that I can for them. But do you think that I had that $20,000? So what did I do? Hello. Credit card convenience checks, writing it, So long story short, I mismanaged the finances on that side in a lot of different ways. But long story short, I got to the point where I was maxed out with my credit cards. And it ain't cute when you maxed out. It's not funny. It's not good. Now, I was the type of person who I never missed a single payment. After I got through college, and we'll go back and talk a little bit about that, but I got my first credit card when I was a student at the University of California, Irvine. I was like, ooh, I'm 18, I'm grown now. I must be an adult because they offer me credit cards. I could just sign and get one. Then I got 2. Then I got 3. Then I got 4 credit cards. And next thing you know, I had a lot of debt when I got out of school as an undergrad. Not to mention my car. I had my first car, my 1987 Hyundai Excel. I love that car. I love me my Hyundai. Y'all can talk about Hyundai if y'all want. I love me my Hyundai, okay? But there did come a time when I just foolishly, I won't even get into that long story why, suffice to say a guy was involved, and Christmas gifts were involved. That involved me paying for Christmas gifts as opposed to making my Hyundai Excel payment. And I didn't make my payment, right? And it might have been 2 or 3, but, they shouldn't have been that harsh with me, in my opinion. Dang, it was only 2 or 3 payments. But don't you know Hyundai Motor Credit Corp came and got that Hyundai? Okay? So then I had a repossession on my credit, okay? So fast forward, like I said, I'm kind of like in my early 30s. I got this $100,000 in credit card debt, and I'm like, this is crazy. I've been asked sometimes, like, did you hit rock bottom? Like, what made you kind of get out of your debt and all this other stuff? And just, for me, some people actually do have to hit rock bottom. They go through a divorce because they're arguing so much about money. I did go through a divorce subsequently, but it wasn't, because of it. What finances were part of it, but that was like one of 17 things. But I didn't lose a job over it. I didn't have to get, I wasn't sick over it. I didn't file bankruptcy or anything like that. Really, for me, it was, and I'm almost, it was more like vanity almost, more than anything else. I got to the point where I was maxed out. I couldn't get additional lines of credit, and I was not able to charge and spend in the manner to which I was accustomed to support that lifestyle that I like to live. That's really the honest truth. And when I say I wasn't able to spend, I mean, you going out to dinners with your friends or whatever, and you're like, oh, I got it, whatever, Have you guys ever done this? You're like picking up the tab or whatever, And I was doing that, except that towards the end there, I would like try to pick up that tab, and the guy would be coming back, walking. The restaurant, the server, the waiter, and I'm like, oh, Lord, please let that credit card payment, don't embarrass me up in here. So at a point, I was maxed out, and then my creditors wouldn't increase my credit lines anymore. So one day I sat down, I wrote down all my bills, and to my horror, to my surprise, I was like, oh my gosh, what have you done, Lynette? I had $100,000 in credit card debt. Well, I paid it all off in 3 years. I never missed a single payment. And then I wrote this book about it called Zero Debt, The Ultimate Guide to Financial Freedom. It went on to become a New York Times bestseller, a Business Week bestseller, Essence Magazine bestseller. I outlined a strategy for people to use, a 30-day action plan to jumpstart their finances, to take it day by day. Because I know when you're in debt, you're overwhelmed. You're just like, where do I start? How am I going to dig out of this hole? How am I going to get this monkey off my back, so to speak? So in my case, I was able to do it by chipping away at it day by day, and I used a ton of strategies to get out of debt. We're not going to talk so much focus on that because I want to talk to you about the credit side of things and how to manage the credit. But I just want you to know, essentially, that I did go from horrible credit to having perfect credit, and so can you, okay? Now, what exactly is perfect credit? Some people say, what does it mean to have perfect credit? Well, you can look at it by different measures, certainly. You can think about what your FICO credit score is, right? Your credit score ranges from 300 to 850 points. Now, if it's 300, I'm going to tell you, that's bad. That's real bad. If it's a three something, I have known a couple people who had theirs in the 3s and in the 4s, and that's, I'm going to be honest with you, that's bad, okay? Now, I'll share with you on one of the future slides about what the industry considers bad credit. But essentially, I want you to think about it in these terms. When you have perfect credit, you're probably in that 760 to 850 FICO score range, and you have lenders falling all over you. That's really what it boils down to. For whatever it is that you want or need, and obviously within reason, like income, notwithstanding, things of that nature. I'm not saying you're going to be able to, go get that $2.5 million house if you're making $60,000 a year. But if you want a credit card, if you need to finance an auto loan, if you are going to co-sign for someone's student loan, for example, you should be able to get acceptance just like that. That's what it means to have perfect credit, to move through the financial system and deal with creditors, lenders, bankers in a way when anytime you need a loan, financing, or credit of any kind, your credit is tight, okay? Your credit is pristine, and you know that there really should be no objections to them giving you credit. That's essentially what perfect credit is about. It's sort of like the peace of mind in the credit space to know I'm good, right? Just like if you walked out here and you said, I'm hungry. I want to go to, take your pick, McDonald's or some drive-through, fast food place, and you want to go order, a burger and, fries and a drink. You would either have confidence that you have, $5 or $10 in your pocket, you got a debit card, you got a credit card, you got something to pay, or you're not going to just roll through that drive-through window, right? You have confidence that I'm about to eat, okay? By the same token, that's what perfect credit is about. I'm about to get whatever it is that I'm applying for, okay? All right, so I told you that the industry standard for bad credit is different than my standard, certainly. I'm telling you, if it's in the 3s, that's real bad. If it's in the 4s, that's real bad. But honestly, if you have under 620, you're considered to have bad credit. Take a look at this chart, and it shows you the sort of breakdown. If you're in that 760 to 850 range, you're in the perfect credit score range. You have good credit. If you have a score down to 700 and above is good credit, okay? If you are in the 650 to 699 range, that's considered average credit. And then it's kind of so-so. In that 620 to 649 range, you'll definitely be able to get a mortgage in that range, 620 and up, okay? But anything under 620 is considered to be subprime or bad credit, okay? Now, nationwide, the average credit score is about 723. I'm not 100% convinced of this. This is just my own thing. I don't know. Probably the folks at FICO are going to be like, Lynette, don't say that. But anyway, I don't know. I just have a problem. I'm just not 100% sure, but I take them at their word and what the statistics show. But according to FICO, and in case you don't know what FICO is or what it means or all of that, FICO stands for Fair Isaac Corporation. That's the Minneapolis-based company that does credit scoring for tens of millions of Americans all across the country, and not just FICO. There's other credit scores as well, like the Vantage score. Most of you probably haven't heard about that. How many of you have heard about a Vantage score? Anybody? 1, 2, 3, 4, 5. Okay. So there are 3 credit bureaus, right? The 3 main credit bureaus, Equifax, Experian, and TransUnion. And the 3 of them got together several years ago and created their own credit score called the Vantage score. It used to be a different numerical system, 501 points to 990. They've recently adopted the same scoring model that FICO uses, and so now it goes up to 850 points. But long story short, because FICO is very much considered kind of the gold standard in the world of banking and credit, about 90% of lenders use the FICO score as the model to determine whether or not to give you credit. So when I talk about credit scores in general, I'll often talk about the FICO credit score, okay? Now, your credit score, you need to know, is derived from the information that's contained in your credit report. So the credit score is merely a 3-digit number that is a compilation of everything found in your credit report. Think about it for a minute in school terms. Anybody remember when they were in school? You guys looking like, ooh, school, don't take me back there. Ask your kids. You know, if your kids or if you had A, B, then they had a 3.5, right? They averaged those out and, you know, right? Or A was 4.0, a B was 3.0, and, you know, remember that? A C 2.0, a D 1.0, and don't bring no C's and D's up in my house. Okay, but anyway, so all of the grades that you got while you were in school were essentially collected, and then they gave you a numerical output called your GPA. And that was your 3-point number, 2.75 GPA, 3.84, you know, 4.0, whatever it was, right? But in essence, those grades, your grade in history and social studies and Spanish class and science or whatever, that was all rolled up together to give you a number, your grade point average. Same is true for your credit. So that 3-digit number is based on all the information that's found in your credit reports. Now, who sees your credit reports? A lot of people. Lenders, insurance companies, employers, prospective employers. Some of you like, ooh, my boss can see my credit report. Yes, your boss can see your credit report. Now, they have to disclose it to you. They have to ask you for it. But one of the main reasons, especially in today's economy, that you need to keep your credit together is because of your job and career prospects. SHRM, the Society for Human Resources Management, did a survey, and they found that 58% of all employers in America do credit-based employment screening for either some or all of their employees. In other words, they're checking out your credit to determine who to hire and who to promote. Because even some of you might say, well, I have a job. I ain't going nowhere. I'm going to retire here or whatever, right? Well, even if you want to get a promotion on the job, you need to maintain good credit, because an employer, even after you've been working there for X number of years, they can pull your credit rating and take a peek and see how you've been managing your finances. A lot of people don't like this idea. A lot of people feel like, what my credit got to do with my job, right? Or they feel like this is not indicative of how good I'll be as an employee, right? Right or wrong, I'm just telling you how the system works. Personally, I don't agree with it. In fact, I've written against this because I think that this is extremely unfair to employees and would-be employees in a lot of ways, especially as we saw through the economic downturn during the recession. A lot of people were out of work. Remember when we had 10 million people out of a job? Obviously, the unemployment rate has come down considerably. It's still double digits in the African-American community, unfortunately. But suffice to say, people who were looking for a job, if you were out of a job and what was deemed chronically unemployed, right, chances are you might have missed a bill or two, paying a bill. And if you were out of a job for 6 months, a year, among the chronically unemployed, okay, now you have a ding on your credit report. And now, because you have that ding, your credit score has gone down. And now the employer doesn't want to hire you. It's this vicious cycle, right? Like I said, personally, I don't believe that the two are, or should be sort of statistically linked. But in the minds of the employer, I'm going to tell you their position. I'm going to make sure that it's clear to you. They do view credit and how you've managed your credit as a proxy for how you would be as an employee. Why is that? They're figuring if you honor your obligations, if you pay your bills on time, chances are you're going to honor your obligations on the job. You're going to come to work on time. You're going to turn in your reports on time. You're going to do what you said you're going to do. Again, right or wrong, this is what they're thinking. And there is some statistical evidence on the back end to support the concept or the notion that folks who are very much in debt or who have, severe financial problems are a greater risk to employers. How so? More at risk of dipping into the company till and stealing, which is why in financial services and banking and things like that, you're going to see a lot of credit checks and things. Anybody who's going to be handling money or customer funds, you're going to see a lot more propensity and likelihood of those folks having to have credit checks. That kind of seems obvious to me, and I can kind of get that, right? But if I'm working at a retail store, or something like that, I'm not 100% sure. But they might say, you know what, you got to take customer money there, and But all of those people who are thinking and suspecting, they might not only, let's take aside illegal activity, like you might steal from the company or something like that. They're also thinking that you're going to be a distracted employee. So you could be working in a factory, and they're thinking, you might not be as focused on the job. You might have higher rates of accidents on the job. You might have higher absentee rates. You might have more calls at work because you're arguing with your spouse or your honey, or you're dealing with calls from bill collectors. So they're thinking, again, right or wrong, I'm just telling you so you can be aware of this on the job. They're thinking that the person who has bad credit is not going to be as solid an employee as the person who has good credit. So all other things equal, if an employer has two good options from which to choose, two good employees, both have a degree, if they want a degree, both have X number of years of experience, but this person has a great credit record and this person has bad credit, which one do you think they're going to hire? That's one of the reasons you need to keep your credit together, okay? All right. Now, here is the heart of what I want you to take away from today's seminar. I should also say, and also to the folks who are watching, we're streaming this as well. Stay with me here, okay? Take notes if you'd like, but I really just want you to focus on the concept and to try to absorb the information that I'm telling you, and to understand that if you don't get this all written down just perfectly as I walk you through some of this, you can reach out to us. You can reach out through the church, or you can reach out to me directly. I have a free financial advice site. It's askthemoneycoach.com. Askthemoneycoach.com. Everybody calls me the Money Coach. And you can email me through info at askthemoneycoach.com. My email is info@askthemoneycoach.com. I will give you this copy of the presentation, okay? You have every single slide and everything that you're seeing right here. And you don't have printouts right now, right? I don't think we did that yet. Okay. So just email me. I'll give it to you. You'll have it, so it won't be a problem, okay? All right. So here is the heart of what you need to know in order to help you to maintain great credit or to achieve perfect credit in the first place. There's 5 main categories that determine your credit score. Number 1, 35% of your credit score is based on your payment track record. In other words, how well do you pay your bills on time? If you do nothing else but pay your bills on time, keep everything else in your credit history and your credit file stable, I can guarantee you over 6 months, certainly no more than a year, you'll start to see your credit scores improve, okay? The very best thing you can do to improve your credit rating is pay all your bills, and I mean all of them, on time, okay? That's number 1. 30% of your score is based on the amount of debt you have outstanding, specifically the credit card debt that you're carrying. Now, a lot of people talk to me because they know I've written a book also, in addition to Zero Debt, The Ultimate Guide to Financial Freedom, which is about how to get out of credit card debt. I wrote a sequel to that book called Zero Debt for College Grads, From Student Loans to Financial Freedom. When I got out of graduate school at USC, I had $40,000 in student loan debt as well. I'm talking separate than my $100,000 in credit card bills, okay? I know a thing or two about debt, as you can see here, okay? Fortunately, of course, I paid it off, and it took me a long time, over 15 years to pay it off. That student loan debt is no joke, okay? But a lot of people tell me, oh my gosh, Lynette, I have a lot of student loan debt, or I went back to graduate school, or I co-signed for my kids' student loans, and I know this student loan debt is dragging down my credit score. No, it's not. No, it's not. Did you take care of step 1? Did you actually pay the student loan bill on time? Don't worry about it then. Some people tell me, oh my gosh, Lynette, we live here in New Jersey. We're in the Northeast. It's ridiculous what we pay in property taxes, and our mortgages are bigger because property costs are much higher here. I got a $400,000 mortgage. I got a $600,000 mortgage. I got a $350,000 mortgage, whatever they might have. I know my mortgage debt is dragging down my credit score. No, it's not. This is kind of crazy, right? Some of you are like, really? You give me that look. Like, no, it's not. Are you paying your mortgage on time? Great. Don't worry about it. What is dragging down your credit score is having high levels of credit card debt, high levels of revolving debt, and that's what credit card debt is considered. That is the debt you need to focus on, and I'm going to explain to you in a little greater detail why that is. Not this second, because I don't want to go off of this information, but I just want you to know, suffice to say, that 30%, when we look at your debt, is talking about your credit card debt. You really want to keep your credit card debt low. That's the way to boost your credit score. 15% of your score is based on the length of your credit history. Long story short, the longer you've established a credit history, the more that tends to increase your credit score. In general, that's why people who are older, if they've managed their credit wisely, paid their bills on time, kept their debts low, etc., all other things being equal, the 50-year-old is going to have a stronger credit score and a more positive credit rating than the 25-year-old is, just because of the length of their credit history, okay? 10% of your credit score is based on the mix of credit or the type of credit that's shown in your credit files. There's 3 different types in general. Mortgage debt, which is just like what it sounds like, right? Your primary mortgage, your second, if you have a second mortgage or home equity loan, you might have an investment property or a vacation property if you have a mortgage on that. Mortgage debt, the typical thing that's attached to real estate, okay? Then there is installment debt or installment loans, things like a car note or a student loan. And then there is credit card debt, which is, as I mentioned, revolving debt. Why does this matter? A lot of people only have one form of debt or one form of credit, depending on how you look at it, in their credit files. If all you have is 3 credit cards, and one is a Sears and one is a Victoria's Secret card, and the other one is a retail furniture store card, that's not too good for your credit profile, not for this category, okay? The credit scoring system actually rewards you for showing that you can juggle multiple forms of debt: installment loans, mortgage loans, revolving loans, credit card debt. I'm not telling you to run out there and get a mortgage. I'm not telling you to run out there and get a credit card. That's not what I'm saying. I'm just telling you that all other things being equal, and this is 10% of your score, those who have only one category typically have lower scores. Some people actually add, if they have no credit card, for example, they will get one credit card and they'll say, my score actually just went up. And I'll walk you through the pitfalls of doing that, which is part of what's in the next category, the final 10%. 10% of your credit score is based on inquiries or new applications for credit. Okay? Now, how many times have you been to the store and some nice lady behind the counter said, "You want 10% off?" Right? Now, you buying $100 worth of stuff. She's about to give you $10 off, right? And you're like, "Oh, yes, let me save my $10. Thank you." But what's that in exchange for? Filling out a credit card application, right? Now, 6 months down the road, you're about to apply for a mortgage. Why are you going to get a credit card right now and save $10 and get an inquiry on your credit report, drop your credit score by 15 points or so, and then cause your mortgage rate to go up by 1/8 of a point or something? That one little decision was not a wise one, right? So you need to think through some of the implications of that. And those inquiries do matter. Those inquiries, as I share on one of the other slides here, account for 10% of your credit score, and an inquiry stays on your credit report for 2 years. It counts against you for the purpose of your FICO score for 1 year. So you need to be very selective, okay? Only apply for credit when you really and truly need it, okay? Let's go on. I love this slide. There's a whole bunch of black people in this room. You're like, what? No, I love this slide because I love to tell my black brothers and sisters about what is in your credit score and what's not. Because I've had so many African Americans, and as you can see, I am black, okay? I wouldn't tell you anything wrong. I wouldn't lie to you on this. Trust me. I'm with you on this. I've had so many people say, "Lynette, they ding us. They, right? They, them, all the universe, the white man, the system, right? Well, automatically because we black. Because we black. Not because we are, no, never mind. But they automatically ding us because, Latino, no, baby, no. That doesn't have anything to do with it. Your race, your income, your gender, your marital status, your job, where you live, none of that goes into your credit score. Did you hear the story about Warren Buffett, the billionaire? And at one point he had horrible bad credit, allegedly. I know he don't need a loan for anything though, right? He got billions of dollars. The point is, income definitely is not a factor. A lot of people mistakenly think this though. They think that I have a 6-figure income, or I make $80,000, or I make X, whatever it is. And they think that that is propelling or helping their credit score. Conversely, some people think, I'm broke. I only make $20,000 a year. Ooh, I know my credit's bad. No, your credit's bad because you didn't pay your bills. Okay? Your credit's not bad because you're a woman, or because you're 21, or because you're 61, or because you are black, or Latino, or white, or Asian, or anything else. Native American, it doesn't matter. Race is not a factor in your credit score. By federal law, credit scoring companies are prohibited from including in their calculation anything that is not predictive. That's why we're seeing a lot of change right now in the area of credit scoring. One of those changes is that they're starting to add what's called non-traditional data to credit reports And in turn, that can impact, of course, your credit score. What's non-traditional data? The traditional stuff is your mortgage payment, your credit card, your student loan payment, auto loan, that kind of thing, right? But what about your rent? You know they're starting to add those rent payments to the credit reports? And actually, it's beneficial to you. If you're renting, and we have 40 million renter households in America, you can actually benefit from it. If you pay your bills on time, if you're paying the rent on time, you should get credit for that. That can help make you eligible for a mortgage if you should ever choose to make the leap from renter to home ownership. A couple of the credit bureaus have done studies on this. They basically found 1 month's payment, adding a single month's payment boosts a person's credit score, usually by 10 or 11 points or more. Just 1 month's worth of positive history paying for your rent. So it's actually positive. And some of you, you should ask your landlord about this if you're renting. Put my rent payments on there. You've been paying rent for 17 years. Go on and let them add that to your credit reports, and it actually can boost your credit score. So you definitely want to know about that. All of these things, though, do not impact your credit score, okay? Your race, your gender, income, all of those things. They're not predictive, that's why, okay? Now, let's talk about some of the general tips based on those 5 categories that I gave you in terms of how you're going to increase your credit score. I told you that the number one determinant, 35% of your FICO score, is based on your payment track record. Thus, you always want to pay all your bills on time. Now, anybody who's sat through any of my debt presentations, like I do a presentation around how to have zero debt, I talk about the minimum payment trap. I tell people that minimum payments now, in the short run, really mean maximum payments in the long run. And part of the reason that I was in credit card debt for a while before I actually dug myself out is because I was only making minimum payments. And I recommend, if you can, double those minimum payments, triple them. If you can't do any of that, pay $25 extra on it. Pay something extra, because credit card companies usually only ask you to pay 2% of the outstanding balance. That means you'll be in debt year after year, potentially decade after decade, and you're just making the credit card companies rich, okay? So you want to pay more. Don't just pay the minimums. However, if you are broke, if you are cash strapped, if you're struggling and you feel like you're living paycheck to paycheck, but you still nevertheless want to increase your credit score, don't just say, oh, well, Lynette told me to pay, she told me to pay twice the minimum. I can't pay it, so I'm just not going to pay it this month. No. From a credit scoring standpoint, all you have to do is pay the minimums, okay? Pay what is due. If you can pay the extra, obviously pay the extra, but do not miss a payment ever. If you're 30 days late, that's when you can be reported to the credit bureaus. Am I giving you permission to pay 10 days late? No. Because I don't want you to have, late payment charges and, all that stuff. But I'm just telling you that if it's 30 days late, you can definitely be charged for that. Not only just that $35, late payment fee and all that they're going to hit you with, but they can put that on your credit reports with Equifax, Experian, and TransUnion. Those of you who have kids and people, young adults who have gone off to college or will be going off to college, please tell them about this. Because when I talk to college students, I've heard so many, crazy stories, and they'll get the department store cards. They'll have their Macy's card or, whatever, card, the H&M card, whatever they want to have, right? And they'll say, and it'll be a low, they might have charged, $300 or whatever. And they'll have $16 due. Something real, relatively small. And they'll say, well, Lynette, no, I didn't pay my $16. I'll ask them, did you pay your bills on time? Did you? Well, no, I didn't pay it, but I did. I doubled up the next month, so I'm good. I paid $32, so I'm caught up. I'm like, boo-boo, it don't work like that. No. I'm like, okay, you got dinged. You got hit with a 30-day late fee. I mean, a 30-day late payment on your credit report, and you probably got hit with a late charge as well. So no, just doubling it. You can't just like, oh, I'm good. I'm making it up. It doesn't work like that. Okay. So make sure those, college students of yours know this, because they kind of think this. I'm not exactly sure why, so a single late payment can hurt that credit score by dropping it 50 points or more. And guess what? For those of you who actually have good, great, excellent, or perfect credit, you get hurt the worst. Why is this? This doesn't seem fair, huh? This doesn't seem right. Think about it logically, though. The person who has a 780 credit score, you're kind of like, whoa, to the credit system. When you miss the payment, they're like, this is very atypical. Something wrong here, and there's probably more to come. There's a problem. So the person who has a 780, yours might drop by 75 or 100 points. Think about it logically. If you got a 480, you don't got much further to go, right? It might go, we'll knock it down another 10 points. Another 10 or 20 points, she already down in the dumps. I'm serious. So when you really have great credit, you want to protect that credit rating, because the slightest little mistake can hurt you even more. Not always fair, not always right. Don't shoot the messenger, but I'm just telling you that this is part of the quirk of the credit scoring system. You also want to maintain low credit card balances. Okay, so remember when I told you about factor number 2, right? That 30% of your credit score was based on the amount of debt you're carrying, specifically credit card debt. The credit scoring system looks at something called your credit utilization rate. Your credit utilization rate, or your credit utilization ratio. What does this mean? It's just a fancy little way of saying how much debt you've charged versus how much credit you have available. Okay? Assume you have 2 credit cards. You got a Visa and a MasterCard. You have a $5,000 credit line for each one of them. So you have $10,000 in available credit, right? Now let's assume that you've charged $2,500 on each one of those. So you have $2,500 on this one, $2,500 on that one. You've charged a total of $5,000. Since you've charged half of your available credit, your credit utilization rate is 50%, right? Now let's say you knocked out one of those credit card balances in full. Let's say you just wiped it out. One of them, that $2,500, is gone. You have $2,500 left. You still have $10,000 of total credit that was available to you initially. So now what's your credit utilization rate? 25%, correct. So you've used 25% of your total available credit. In general, you kind of want to keep it at a max in that range, in the 25-30% sort of category. When you want to really start managing your credit, go home and take a look at all your credit cards, peek at what the credit lines are, right? And then see, what's the balance on each one of these? You'll be able to figure out your own credit utilization ratio. If you pull your credit scores and do things like that, you'll also be able to, it'll tell you what your credit utilization rate is. The lower your credit utilization rate, your higher your score will be. FICO high achievers, that's what they call them, folks who have perfect credit in that 760 to 850 range, they usually have credit utilization rates between 1% and 9%. That's serious, right? So they have credit at their disposal. They actually use credit. Mind you, I didn't say that they have 0% credit utilization rate. They actually use their credit cards. They use them, but they use them responsibly and pay them off. And they have low credit card debt levels, okay? You'll see one of my tips here is about spreading out credit cards spreading out debt over multiple credit cards so that you're carrying it on multiple cards as opposed to on just one. Why do I say to do this? Does it really matter? Yes, actually it does. This is a strategy for you, okay? Remember I told you about those 2 cards that you have? Let's amp it up. Let's say you have 4 credit cards, okay? Let's say that you have $2,500 on each of those 4 credit cards. So now, remember I said that you had a $5,000 credit line available to you. So you have a Visa, you have a MasterCard. Now let's throw in Amex, American Express, and Discover. And let's say all of them have a $5,000 credit line, right? You have $20,000 now in available credit, right? Stay with me now. If I can do some math in my head now, come on, you can stay with me. Okay, so now let's assume that that $5,000 that you had charged before, because you had $2,500 on one of them, right? Let's assume that you have $2,500 on each one of them, okay? So now $2,500 on here, $2,500 on here, $2,500, $2,500 on the fourth one. $10,000 in debt, right? $20,000 in available credit. You still have 50% credit utilization rate, right? What if you got a balance transfer offer from one of them and they said, here, you paying 16% on this card, come over here, 6 months or 12 months, 0% offer. We will let you do a balance transfer up to the full credit line, either a new card or your existing credit card. So you took $2,500 off of one of those cards now and you put it onto the other card, right? So now one of your cards has 0. But the other card, let's say the first credit card, the Visa, you took that $2,500 off of there and you transferred it to the MasterCard. Now that MasterCard has $5,000 on it, right? The other two still have $2,500. Has your debt level changed at all? No, you still have $10,000, right? However, the credit scoring system is not only going to look at your collective debt, they're going to say, how many credit cards do you have? They're going to say, this person has 4 credit cards. How many have a balance? And they're going to score you on that. So now 3 of them have a balance. And then they're going to see, what's the credit utilization rate collectively? 50%. But also, what's the credit utilization rate individually? So now one of your credit cards is maxed out, right? It has 100% credit utilization rate. You might have closed out that first card, that Visa. You might have said, I'm kissing Visa goodbye, right? So, you might have thought, I'm smart. I'm outthinking the system here. Well, really not so fast. You just dinged your credit score in multiple ways. First, you closed out that old account. You're choking off your credit history. Remember, 15% is based on the length of your credit history? It's better to keep those older cards, those more established cards, open. Secondly, you transferred all the credit card debt to one card, and that card is maxed out. It has 100% credit utilization rate. You didn't do anything in terms of making yourself more risky. You didn't add to your debt. You didn't miss a payment. But in the credit scoring world, you appear to be more risky because you have this one card that's maxed out, right? Heaven help you if you actually didn't put that balance on an existing card. If you, say, got a new credit card offer in the mail, and then you accepted that. You know why? That was a third mistake compounded on there. An inquiry, because you applied for new credit. So 3 things you just shot yourself in the foot, right? Again, some of the quirks and nuances of the credit scoring system that you have to be aware of. All right, I told you keep those older accounts open. The longer, the more established account, the more that tends to benefit your FICO credit score. Some people ask me, oh my gosh, Lynette, I just closed that account. Should I go back and open it up? No. Two wrongs don't make it right. Don't go, let it go, let it go, let it go. You know, start singing Idina Menzel up in here. Okay, no, just, it's frozen. Consider it frozen, okay? Let it go. No, don't do the same thing because you're going to have that inquiry. Just learn from the mistake and move on, okay? So, but people do ask about that all the time. All right. You also have to avoid bad forms of credit. So I tell people all the time that all debt is not created equally, okay? There's a hierarchy and a tier in the credit world to the types of debt that you have. Remember when I told you before that 10% of your credit score was based on the mix of credit or the type of credit in your credit files, that you could have mortgage debt, installment loans, or revolving debt? Well, some people say, how come the credit card debt is the one that they're just judging me so harshly on? How come they only care about that credit card debt? I'm going to explain it to you. And then you'll probably see like, oh, okay, I do get it. Okay. When you have a mortgage, you're paying on that every single month, hopefully without fail, hopefully on time, right? And we're going to assume for all these three different types of debt, mortgage debt, installment debt, and revolving debt, that you actually are paying the bills on time. We can talk more through our Q&A session if somebody wants to get some tips about what to do if you can't pay on time. But let's just assume that for the sake of this part of the discussion that you are actually paying the bills on time, even if it's minimum payments on the credit cards or whatever. When you pay your mortgage is composed of two parts, right? You have the principal and the interest, right? Little by little, the balance is being chipped away through a wonderful process, called amortization, right? You're paying a little bit of the principal, especially in the first 7 to 10 years of the life of the loan. Mostly it's interest. But once you get past that first decade hurdle for a typical, say, 30-year fixed rate mortgage, then it kind of switches. You start paying more principal, right, than interest. When you make that mortgage payment, what does your balance do? Decreases. The balance only does one thing. You're not adding to it. It's just constantly going down. Ditto for your installment loans. When you make your student loan payment, when you make your car note, you have your, Toyota Corolla, you have your, Honda Civic, you have your Range Rover. No, I'm just joking. No, I'm not putting you on that. Whatever your car is, if you have a car payment, you're paying every single month. Maybe you have a low interest rate on it. Maybe you have a 0%, whatever. But the balance is only doing one thing. It's going down. Ditto for your student loan payments, right? You graduated, your kid graduated, whatever. You're paying the student loan payment. The balance is only going down. But that revolving debt, that credit card debt, there's a reason they call it revolving debt. Picture a revolving door. It's constantly changing, and it's highly unpredictable. It's highly unpredictable. Why is it highly unpredictable? Can somebody in here tell me what's their, and don't be ashamed, just one person. Somebody here tell me what's your mortgage payment. One person. Anybody? Who? Quick, come on now. We got to move on. $1,800. Perfect. All right. When you pay to X lender, I don't need to know who the lender is, they're expecting a payment from you, $1,800 a month. When you pay to your bank for that Visa card or that MasterCard, that American Express, that Discover, assuming that, you don't have the type of American Express, because some people, there's two types. You can pay it off in full, or there is an American Express that you can charge and make payments along the way. But let's just assume typical credit card, you can pay whatever you want to pay. You can make minimum payments. You could pay two or three times the minimum payments. You could pay off the balance in full. You could pay half of it. They don't know what you're going to pay. Highly unpredictable. And what else? You can add to the balance. You could charge more. You could be like, you know what? I want to go to Hawaii. You know what? I want to go to Lord & Taylor. I want to take my friends out to dinner. They don't know in any given month. And not only that, guess what else? Are you walking around with a mortgage in your pocket? Are you walking around with a student loan in your pocket? In other words, you're walking around with that wallet with the credit card in your pocket, right? You have so many opportunities to use it. I saw one study that said some people use their debit or credit card 5 to 7 times a day. That's a lot, right? But you actually could. You could go in the morning, you run and you get your cup of coffee, you go stop someplace, you go out to lunch, you're commuting from Jersey to New York, you go through the toll, and you might have your Easy Pass linked to your credit card or something. That's another payment. You could, in theory, you could be using that thing 2 or 3, 4 times, 5, 6, 7 times a day. That's a lot of information and data for the credit scoring world, and they love data. More than anything else, they love data because they try so hard to be able to predict what you're going to do. for most people, they can tell. They can say, chances are this person's going to keep making minimum payments because she always makes minimum payments. The last 4 years in a row, she ain't paid nothing but the minimum payment. Okay? They love you. You're a real good customer to them. Okay? They get a lot of interest off of you. All right. So my point is that for some of you who are trying to figure out why is it that the credit cards matter so much, it's because all debt is not created equally. You're riskier to them when you're using the credit card debt because you have so much more opportunity to use it, because you can add to the debt, and because it's highly unpredictable. They don't know what you're going to pay. With that mortgage debt and that installment debt, those student loans and auto loan, they know what you're going to pay. Your car note is $287, you're going to pay $287. Your mortgage is $1,800, you're going to pay $1,800. Your credit card debt, that's another story. They don't know what you're going to pay. Now let's break it down even further. In the credit world, there's even more finely sliced and diced tiers. When I say all credit isn't created equally, all debt isn't created equally, even in the credit card debt space, there's tiers of that, and they're judging you on that too. How are they doing this? National tier cards, that Amex, that Discover, that Visa, that MasterCard, those are the upper tier of the credit scoring world. All that other plastic in your wallet, those department store credit cards, you run it up in Target every day, and all, those department stores, and you like, I got to have my, Victoria's Secret, my whatever, all those other little cards. That's lower on the scale than is the national brand card. Then there's a tier below that, the sort of subprime almost of the credit card world. You know what those are? It's like the furniture store cards, those retail cards that are like you get a loan from some just random place that just offers credit, and they're offering you the credit because they know some people don't have a national brand card. There's a reason. They already know there's a reason you're getting credit from them. Because really, if you had traditional credit, if you had a national brand card and you had a $5,000 credit limit, you probably just use that, right? So you need to understand that all debt, all forms of debt are not equal in the credit scoring system. How do you use this information? I told you before, say no. When that nice lady behind the counter offers you a credit card just to get 10% off or whatever, no. Think about the impact that's going to have on your credit score in terms of an inquiry being generated, not to mention that almost all department store credit cards, retail cards like that, have double-digit interest rates, much higher than the national brand cards. It's just not worth it, okay? Say no to that. Only apply for credit when you truly need it. I told you this before, right? Because that inquiry is going to stay on your credit report for 2 years and count against you for a full year. Everybody has their different numbers or their differences of opinion in terms of how much an inquiry will impact your credit rating. Mortgage Bankers Association said a single one can lower your credit score by 35 points. The last inquiry that I had that lowered my credit score, I was too salty about. I went to this was about 2 years ago. This was more than 2 years ago. I went to a conference, I was speaking at the YWCA in Arizona. And I can't remember, I think I was in Tucson. I was going to say Tucson or Phoenix. It was in Arizona. I had a rental car because I was by myself, and I went, for a day or two to do this speaking engagement at the YWCA. I went to Avis. Yes, I'm putting Avis on blast. No, just joking. This is not a knock against Avis. This is a reality of the credit scoring world. I went to rent my car. I was like, okay, I opened my wallet. I pulled out my debit card because I was like, okay, I got the money in the bank. I gave him my debit card, and I proceeded to rent the car. And then I did this happen to you before? So I went on about my business, did my speaking engagement, came back home. That night or the next day, I had an alert because I used a credit monitoring service. I'm nuts about my credit, and so as you might imagine. The alert said there's an inquiry on your credit report and your credit score dropped. I think it was 16 points. I was like, what? said, I'm getting online immediately. I'm like, oh my gosh, identity theft. Somebody must have did something, got my social security number, an inquiry there. Somebody's applying for credit who I don't even know what's going on. I look in there, I log in, and it said Avis. And I was like, Avis? I said, well, I didn't apply for loan. I didn't seek a job at Avis. What? I said, I rented a car from there, but what? Well, I get on the phone, I call this woman up, and I'm chewing this woman out. I'm like, I'll have you to know, I've written a book on credit. I don't even, you know what? I jealously guard my credit rating, and I don't appreciate you guys, pull my credit report for some reason. I don't understand, and I'm just going blah, 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 blah. And then this woman is like, oh, she's all nice and sweet, and bless her heart. She said, you are so right. She was like, I can't explain it. She was like, I don't know. So after like 10, 15 minutes, the lady's like, let me just give you to my supervisor because I don't really know. So supervisor gets on. I don't like the fact that you guys I'm fussing again. The lady is patient and calm. She hears me out. And then after about 5 minutes, she goes, by any chance, did you use a debit card? And I said, yeah, I did actually, yes. So she said, oh, yeah, that's it. And I was like, what's it? And then she said, well, we do say in the fine print that, and I was like, no. I was like, what? I said, no, this was not in my contract. This was not. What are you talking about? She goes, let me take you through it. I'll walk you through the webpage. So we go on the webpage, scroll down, page 16 in 8-point font, practically. Sure enough, there's a notice that says if you use a debit card, they have the right to pull your credit report, essentially. That's what it said. Now, as I said, I'm not putting Avis on blast. This is going to happen if you go to Hertz, Budget, Duck Car Rental, whoever you're going to go to, okay? But again, one of the quirks of the credit scoring world and one of the pitfalls for us as consumers to know about, because sometimes we do things thinking we're doing the right thing. But from a credit scoring standpoint, it's actually hurting us. I would have never dreamed that using my debit card, I got the money in the bank, I'm going to pay for my day or two worth of car rental. I would have never thought that was going to hurt my credit report, fall on my credit report in terms of an inquiry and hurt my credit score. But it did. All right. So now I want to walk you through the 7 steps. I told you I was going to give you 7 steps. I gave you the general tips in terms of, and you have the concept behind what goes into your credit report, right? I want you to know that this credit scoring system that I'm about to reveal to you, it totally works for whoever you are. Don't give me your excuses. Don't tell me, well, I'm single. Well, I only make $30,000 a year. I'm black. I'm 32. It's going to work for anybody. Married, single, old, young, whatever your income level is, this is something that can work for you if you implement it and put into practice some of the ideas and strategies that I'm about to share with you. Okay? And you guys keep me honest on time here, too. Somebody can count me down when we're at about 20 minutes before I need to stop, and then 10. That'll be helpful to me, too. I'll make sure. But I think we're doing just fine on time. And, of course, we're going to leave plenty enough time for questions for you as well. Okay? All right. Here is the outline of the perfect credit system. I call it perfect credit, and I outlined it in this way because you're going to be able to remember it literally by the word perfect. The P in perfect means pull your credit reports and your scores, and you need to do so regularly. Unfortunately, most Americans do not do this one basic step to start with, okay? The National Foundation for Credit Counseling says that most adults in this country haven't looked at their credit report in the past year. That's a huge mistake. All you got to do is go to annualcreditreport.com. It's a federal law that gives you the right to get your credit reports free of charge once every 12 months from each of the big 3 credit bureaus, Equifax, Experian, and TransUnion. Okay? I personally believe you should also be pulling your credit scores, your FICO credit score, perhaps your Vantage score as well. And there's ways that you can even get those free because of changes in the credit scoring world. FICO scores, again, it's a company, Fair Isaac. They charge you for it. It's about $48 to get the 3 different FICO scores. Why did I say 3? You have a FICO score based on the information in each of the 3 credit files. So you have an Experian-based FICO credit score, an Equifax-based FICO score, and a TransUnion-based FICO credit score. Then, separately, each of those credit bureaus, credit reporting agencies, sell their own proprietary products. They sell their own their own credit scores, okay? You could go crazy with in the credit scoring thing, but in the scheme of things, each one of them does matter. Examine those credit files thoroughly. A lot of people are like, I can't make heads or tails of this. They don't know what to expect. One of the things that's probably the single most popular article on my website on AskTheMoneyCoach.com is how to compare your Equifax, Experian, and TransUnion credit reports. There's kind of a whole art and science behind that, and I walk people through what to look for, what's different about the three of them, what's common, etc. But you need to examine those files and sort of know what to look for. Okay? Reducing debt. That's the R in perfect credit. I told you already how 30% of your credit score is based on the amount of debt you're carrying, specifically the credit card debt. Okay? F in perfect stands for fixing errors or mistakes in your credit report. Consumer groups have shown that about 70% of all credit reports have mistakes or errors in them. A lot of times the mistakes are big enough to cause you to be either denied for a loan or to have an impact on your eligibility in terms of maybe making you get a higher interest rate than you really truly should qualify for. You might qualify for something better if the information was accurate in there. The second E in perfect stands for enhancing your credit files, adding positive information to your files, which is something that you should be doing constantly. The C in perfect credit refers to you contacting your creditors, dealing with them on the up and up regularly, and also knowing how to negotiate with them when necessary. And finally, the T in perfect credit talks about the time that's involved, taking the time to reevaluate your options, to see what's new and different, and to keep abreast of the credit landscape because there's always something new, different, and changing. I said this in Perfect Credit when I wrote the book, that's one of the only things we can be sure of is that it's going to change. And things have indeed changed, certainly since I wrote Perfect Credit. All right, so I'm going to walk you through a little bit more and flesh out, and I'll whip through some of these, but others I'll take a little more time on. So I told you already that you need to pull those credit reports and your scores regularly. Annualcreditreport.com is the federally sanctioned site that you can go to in order to get your credit reports free of charge. Honestly, I've had a number of people tell me, I went to the site, but I couldn't even get my report from there. I was locked out, or I got, it was a problem for me to get it for some reason. After I got a number of people asking me this, I also wrote an article about this to walk people through step by step just how to access your credit report on annualcreditreport.com. I realize that not everybody is very sort of tech savvy and online, and there are a couple of glitches in the system. Like if you get up and walk away from your laptop or desktop at home and your computer while you're trying to access your free credit report, it's going to time you out, it's going to kick you off, it's going to make you jump through a little more hoops and hurdles in order to access it. And if you don't know what to expect, they're going to ask you 3 questions, some stuff that only you should know. So, and some of it is historical. So they might say, you previously lived in Philadelphia, and you had a mortgage in Philadelphia. What was your mortgage back then? Or they might say your current mortgage is $1,800 to $1,820, or $1,821 to $1,840, or $1,841 to $1,860. And if you're not managing the finances in your household, you're like, honey, what was the mortgage? Is it $1,820 or $1,821, right? So there's a couple of little things in there, and obviously they're taking your security and privacy very carefully. They're taking it seriously, and they are being careful about it. So, but the point is, get online, get that credit report, and you can get it for all 3 of them. My FICO offers their product, like I said, for credit scores. But honestly, a lot of other places you can get the scores free now. So Discover is offering you your credit score free, your FICO credit score free every month if you have a Discover card. Barclays Bank, if you have a Barclays card. Capital One offers a free credit score. So, I mean, there's a lot of other ways, and there's services. CreditKarma.com gives you a free credit score, stuff like that, okay? All right, so when I talk about analyzing the information and examining the information that's in your credit files, part of what you want to look for is differences. And anybody who has pulled their credit scores or their credit reports in the past knows that you'll see something and you say, how come this information is not the same on this report that it is on there? And that's actually not so uncommon. Part of it has to do with the way that credit furnishers supply information to the credit bureaus. What's a credit furnisher? A credit furnisher is an entity that has agreed to, on a monthly basis, report your credit data without fail. So they have to report the good and the bad. They can't, so a landlord, for example, that says, I'm going to become a credit furnisher and supply information about your monthly rental payments, they can't just threaten you and say, I'm gonna report you to the credit bureaus because you haven't paid. Well, if they're not already, reporting you and everybody else, don't just be all worried and take that threat all too seriously. Of course, pay your rent on time anyway. But just in the scheme of things, the credit furnisher has to have a business relationship with the credit bureaus, and they have to update that information on a regular basis. Okay? Each one of them will have sort of codes attached to it. Some of them risk codes, and some of them, the main thing you really want to look for, though, is public record stuff, right? So what's a public record? A judgment, a collection, a charge-off that's been, went to court and someone actually got a judgment against you, a foreclosure, a repossession. All that stuff is public record. And all that stuff hurts your credit score dramatically, okay? So you want to see what's there because then you know what you need to focus on in terms of fixing some of the problems that might be in your credit report, okay? When you're examining your credit reports, you want to watch for certain statements. You want to watch for certain negative statements in particular. They'll tell you about things. They'll tell you reason codes. For example, your credit score is low or there's problems with your credit because your balances are too high. You had a missed payment. They'll tell you about delinquencies. The public record is the most severe of the delinquencies. In general, any negative information can stay on your credit report for 7 years from the date of last activity. Remember that little, and we'll put an asterisk next to that because I'm sure somebody's going to ask me about it later when you're dealing with collections or creditors. Some things can stay on your credit report, though, for 10 years, like a bankruptcy can be on there for 10 years, okay? Reducing debt. I won't focus too much on this. I've told you that the credit card debt is the main thing that you want to focus on. And I've suggested here that all your debts, even library bills, you want to pay on time. You know why? A lot of municipalities are cash strapped. You guys know this, right? Parking tickets, speeding tickets, library bills. Because all of these local, state, and even some federal agencies are cash strapped, they'll turn your stuff over to collections or get a judgment against you. Now, you think I'm joking when I say library bills. Across the country, many municipalities did this. Somebody had a $38, library fee that was overdue, and it wound up on their credit report. Fortunately, there's been changes recently in the credit scoring world. And I just want you to know, because I don't want you to worry too much, like, oh, my God, I did have a $38 library fee myself. In essence, what FICO has done and what and recently, as in sort of a month ago, what the credit bureaus have agreed to do also is very consumer friendly. One thing is that FICO said for anything that's under $100, we're going to kick that out. So if it was a $93 bill of some kind and it was, shown as a collection or shown somehow it's still going to be there, but they're not going to count it against you for the purpose of calculating your credit score, right? So those small bills like that won't count against you. Medical accounts are something that is, remember when I told you in the credit scoring world, really they're only supposed to be able to put stuff that's predictive. So a lot of people have had a lot of outcry about medical bills and things like that being ultimately placed on somebody's credit reports and then being a factor in their credit score. So now the credit bureaus just reached an agreement with the New York State Attorney General, and they agreed to implement over the next, they have up to 36 months to roll out all these different components of this new model to make it easier for people to dispute information in their credit reports and also to make some changes in the way that credit bureaus handle information that's supplied to them that's negative about consumers. One of them pertains to medical bills, large or small. In essence, if somebody reports you, for being late with something, with a health-related sort of account, a doctor, a provider, a hospital, a healthcare practitioner, et cetera, they're going to have a 6-month grace period. They won't just automatically put it on your credit report. And the idea is that they want to give the consumer and the healthcare provider a little bit of time to work it out. Maybe the insurance payment just hasn't been made. Maybe you disputed it and said, I didn't really have these services. Whatever the case, they don't want it to just automatically go on your credit report and to ding you. But suffice to say, still keep the concept in mind about lowering your debt and managing it wisely in order to boost your credit score, okay? I told you before about the length of your credit history mattering, so you don't want to close old accounts, right? In fact, the longer, more established accounts are the ones that you want to keep open. People sometimes ask me, well, this card, I know I've had it for 10 years or 20 years or 6 years or whatever the case may be, but they're charging me an annual fee. I don't want to pay, or I don't even charge, or I don't even really use the card. Should I still keep it open? Yes, you should. The reason you should keep it open, it's up to you. I'm just telling you my advice as somebody who has perfect credit, but you can take me at my word or don't. All right? Do what you want to do, but don't come back later telling me I should have listened. Dang. So here's the deal. This is what you do. Negotiate. You don't have to, call up your company and say, you know what, I've been a customer for 6 years, 10 years, 15, 20 years. I'd like for you to waive the annual fee. You'd be shocked how many times they'd be like, all right. They'll just waive it right there on the spot. Ditto for lowering your interest rates. I'm going to double check because I just got a question from my husband, a signal. Somebody just told me 20 minutes. You just told me 5. Which one is it? Okay. So they want me to, so first they told me 20. Okay, I'm going to whip through this for real now then. Okay. For each one of you, though, who are thinking about whether or not you should keep an account open, the reason I think that you should is because it'll help the length of your credit history and because you still do have leverage with your creditors. You can negotiate over an annual fee and get that waived. Also, keeping the account active is a good thing because of the credit utilization factor. Remember I told you if you have $20,000 in credit utilization, well, when you close an account, that credit line is also going away, so you could be impacting your credit utilization. So if you close an account and you only have 1 or 2 other cards and those have, say, lower lines of credit, or even if it doesn't matter, even the credit lines can be larger than the one that you're actually closing, you're still nonetheless going to impact your credit utilization rate, okay? So it's to your advantage a lot of times to go ahead and just keep it open. Sometimes you charge on it and only charge what you can pay off every single month because then the creditors, when you don't ever use it or charge it, they will lower your credit line or they will just close the account due to dormancy or inactivity, okay? So you want to keep that in mind. All right, fixing errors. You have a right under the law to dispute anything that's erroneous, anything that's outdated, or anything that can't be verified. This is federal law, okay? People don't know this, though, and so they just sometimes tolerate mistakes and errors on their credit reports, and you really shouldn't. The Fair Credit Reporting Act is the law that governs this, and the credit bureaus have 30 days to act on your inquiries or on your requests for negative information to be removed. Fixing your credit report, though, isn't just about getting rid of the mistakes. It's also about increasingly protecting your credit and watching out for identity theft in a whole number of ways. We just got through tax season, And I hope none of you got this alert or this feedback. If you tried to file your if you tried to file your taxes and then you got a notice, that said, the IRS rejected your taxes, your federal 1040, because your Social Security number has already been used. Identity theft related to your Social Security number and related to taxes is a huge and growing problem. Millions of people get affected every single year, and the IRS had to set up a whole special division just to deal with this. But when somebody steals your Social Security number, that's kind of the keys to the kingdom for them. They can open new accounts, they can get a bogus tax refund in your Social Security number, and then you have to fight to get your refund back and all kind of problems. So you really do want to guard your credit. Don't just leave your purse hanging around like I've done here in church. But I'm going to trust y'all up in here. But seriously, on the job, don't we do this? You walk away and you're like, oh, it's just my coworkers. I'm not, but your coworkers might just be fine. But what about the delivery guy? What about the person who's, washing the windows, or the contractor who came in, or the visitor who's coming to visit a friend, or whatever? So, be protective of that stuff. Don't let somebody get your personal, financial, and very sensitive data. Adding credit information to your report, enhancing your credit files is also very important. This is a way to boost your credit rating. How do you add information? Well, one of the things you need to add, one of the key things you need to add is your credit limits. Now, some people might say, well, isn't that automatically reported? No, not all the time. In fact, one survey showed that 46% of files had a credit limit that was not being reported. This is serious. Why is this important? Because the credit scoring system, the credit scoring world will make a certain assumption. They will assume that whatever your past credit spending habits were, whatever your high credit balance was, that was actually your credit limit. So if the most you ever charged up was like $1,000, but really this credit card has a $5,000 credit limit, they will assume that $1,000 was the credit limit. And isn't that going to impact your credit utilization rate? And isn't that going to impact your credit score? So you should add that kind of positive information to your credit reports. Some people like to add other things regarding their job status, correct names, and all that. Some of that is not going to impact your credit score at all. As I mentioned, your job and your income, that doesn't. But for other purposes, it's helpful if a lender, for example, is going to pull your credit report and they like to see stability, and they want to know that, you have a job, and they're going to verify it anyway. But sometimes they like to see that as a double check, as a sort of reinforcement reflected in your credit report as well. Contacting those creditors and negotiating, this is something that you should always be doing, especially if you have problems. I like to emphasize a PFD, a pay for deletion. Pay for deletion. The concept here is very simple. A lot of people will negotiate and get a bargain. They'll do something with a creditor and say, here, I know I owed you this. Here's current or past due account or account that was in collections. All of those efforts, frankly, are for naught if you don't get the information deleted from your credit files. A lot of people have talked to me about this issue. They're very sorely disappointed when they pay a big lump sum and then the status on their report, on their credit report, changes. The status notation changes. That's all. It says, was delinquent, was 90 days past due, was charged off, was in collections, now current. And that's it. And do you know the credit report still reflects that? The credit score does not change at all. So anytime you negotiate with a creditor, you want to make sure that that negative information is deleted. So when you write a letter to them, when you negotiate, and always follow up with a letter. Don't take anybody's word, okay? Get it in writing. I, Jane Jones, promise to forward you payment of, $1,200, $250 as payment in full for this account number 123456. In exchange, you agree to delete all negative information from my Equifax, Experian, and TransUnion credit reports. Signed here, agreed, and signed there, agreed by the other party. So you email, PDF, fax that information over to them first after you call them, negotiate, and stay in contact with them. Then get their signature And once they give you the signature, then you give them the check. Don't give them the money up front before, okay? I've had many people tell me, they promised, or I gave them the money and they didn't do it. Well, what proof do you have? Get it in writing, okay? C, I'll tell you about the contact them for this. Great, pay for deletion. I'm with you guys. And then your options. Everything in the marketplace is going to change. Interest rates rise and fall. New offers come in the market. Stuff happens, too, in terms of your own sort of standing. You might move from one location to another. You might get a better job, have a higher income, maybe qualify from a DTI, a debt-to-income standpoint for higher lines of credit, et cetera. So you need to be constantly exploring some of that, okay? These are the last two slides, you guys. I did make it through on time. What's the future of credit scoring? I told you they love data more than anything else. You would be surprised at the number of quants and the number of, really, these guys have PhDs and they are seriously analytical thinkers. They are figuring out everything about what you do and what you're likely to do. And they're making a lot of credit decisions, marketing decisions, cross-promotional decisions based on all of this enormous amount of data that they're collecting about you. And when I say enormous, they're looking at everything from, if you accepted the credit card offer, did you accept over the phone because of a mailing that you received or through an online offer? How quickly did you respond? Did you take it that day? Or were you a person who, it was like towards the end of the offer, it said, accept this by May the 30th, and you did it right on May 30th. They're looking at, how do you pay? Do you always pay, 5 days before? Do you always pay on the day the bill is due? Are you always 5 days late? They're looking at all these decisions. And they're even looking at where you shop, where you spend money. At one point, a big retailer got into trouble because of this, or the retailer didn't get into trouble, the sort of credit scoring world. The gist of it was that some folks said, I got dinged. I saw some things happen in my credit report because I was shopping at Walmart. And in the past, I had been shopping at Macy's, for example. And it's like, for whatever, went down, from the credit scoring standpoint, those who were scoring were essentially saying, their credit profile has changed. They used to shop at these mid-tier sort of to high-end places, and now they're shopping at discount retailers. And in their minds, the quants and the analytics folks, they were thinking like, is there a problem here? They think that when there's a problem, when they see your spending patterns and some things, like if you're gambling all the time, okay? If you're taking cash advances a lot, if you're in the casinos, if some people I've heard have said that when they had charges to divorce counselors or therapists, that to them signaled something. So you need to be mindful of that. All of this credit scoring is going to be used for something. They're going to think about, who should we extend offers to? Who should we approve? Who should we give a teaser rate to, a temporary 0% offer, things of that nature. You need to understand how the credit scoring system works, not only because it's going to impact your ability to get credit and loans, as I mentioned, but also because of other things. Your credit rating also determines in part your car insurance rates. Your credit rating helps establish your viability as a job candidate, as I mentioned, or even to get a promotion on the job. And then, to me, personally, I like to tell people to get their credit together and to have themselves in a positive place and on the road to financial freedom because of what it does in your life. Who wants to be broke, stressed out, arguing with their spouse about money, in debt, worried they're not going to have the credit whenever they need it or want it? Nobody, right? Nobody wants to live like that. That stuff impacts you not just financially, emotionally, in your relationships, physically. I was just on Dr. Oz on the 16th. It aired. We did a segment, and I'm going to do another one with him next week because he's one of the people who definitely recognizes the links between your physical well-being and your financial well-being, right? because nobody wants to get an ulcer, be stressed out, sleepless nights, headaches. This stuff has very real implications. So I hope that some of what I've shared with you today will help all of you to manage the debt side of things, to understand the credit scoring world, and to indeed achieve perfect credit. Thank you. Now, we've promised that we will take questions, preguntas. Okay. Yes. Go ahead.
Strategies of rebuilding tarnished credit.
Mm-hmm.
I'm in a position where I have paid off settlements, brought my mortgage current, but I still have a mortgage, I still have an installment and student loan debt, I now have no credit card debt. So I know that I need to, I'm asking you the question, do I need to, yes, thanks. Do I need to open some forms of credit card to widen the kinds of debt that I have, but then to also kind of build my score to have a credit line and have that revolving debt?
So her question, for anyone who didn't hear it in its entirety, boils down to this. She's repairing and rebuilding her credit rating. She's recovered from some credit problems in the past and currently has a mortgage and an installment loan as well. No credit card debt. And should she acquire a credit card? I would say yes, you should. I always tell people don't apply for more than one or at most 2 credit cards over the space of any 12 to 24-month period. For someone who actually has mortgage debt and installment loans in their credit profile, and who's trying to rebuild, the addition of revolving credit to your credit file is typically an enhancement. Now, here's the challenge, though. Because you've had credit problems in the past, you might say, somebody might not approve me. I have no idea what your credit score is at this point. I can give you 2 resources, though. One is through Capital One. They have a tool online to sort of let you see, like, based on your credit score, what you would likely qualify for. And it doesn't do a hard pull, so that you can kind of know up front if you're going to get approved for that credit card or not. And a hard pull, by the way, I should clarify because I didn't touch upon this when we went through the presentation. There are 2 types of pulls or inquiries: a hard inquiry or hard pull and a soft pull. A hard pull means that you as the consumer sought credit or a loan, and that's the type of inquiry that's going to stay on there for 2 years and count against you for 12 months. A soft inquiry is just you reviewing your credit report, or an outside, a third party, an existing creditor, for example, reviewing your credit history. It does not impact your own credit score or your credit rating. People often ask me, well, if I pull my credit report and look at isn't that going to hurt my credit score? No, it does not. So that's one option for you. A second option, and perhaps likely the best one, is to get a secured card. A secured card differs from a traditional unsecured credit card in that you have to put up a deposit. So the reason they call credit cards unsecured debt is because there's nothing attached to it that a creditor can come back and get. If you have a Visa card and you go out and you buy a $1,000 flat screen TV, but you don't pay that Visa bill, they can't come and snatch the flat screen TV off your wall. But your mortgage and your car note, those are secured loans. In other words, the loan is secured by the actual asset. If you don't pay that mortgage, they can foreclose upon the house and reclaim the property. If you don't pay that car note, same thing happened to me with my Hyundai Excel. They can come back and take your car. So with a secured card, you put up a set amount, let's say $500, $250. You put that on deposit with a bank. And the amount you put on deposit becomes your credit line or your credit limit. So if you put up $250, you have a credit line of $250. Now you can go charge or spend on something. Then you should pay it off in full every single month. It's secured for them because they know they're not going to let you charge above $250. And if for some reason you don't pay it on the back end, they'll take that $250 to pay. Kind of like what a landlord does when they take first and last and they get that deposit. They're like, if you skip out on me, oh, well, I got this, right? So that's the secured option. And for a lot of people who are rebuilding, a secured card is the way to go.
Okay. Thank you, Lynette.
Yeah.
So we still have a few questions in the audience, and we also have some online.
Perfect.
And we have one more presentation that we need to get through.
Okay.
So we are a little
We'll
bit
through.
pressed for
Okay,
time.
sure.
So why don't we have a question here, and then Lenora, I know you have a question. Take a few from here, one online, and then we'll move to the next presentation.
Okay.
Okay?
Lynette, thank you so much for your
You're
information
welcome.
today. But I had a question. You mentioned you had an alert. Now, is it necessary today to have one of those security alerts on your credit, or are there free ones that you can also volunteer to submit to? How would you recommend doing that?
Great question. I did have an alert, and I've used probably every product and service out there in terms of credit monitoring services. I'm a huge believer in credit monitoring. These are paid services, and they'll be anywhere from $9 a month to maybe $15 a month or $4.95 a month if they have a special promotion or something like that. At the time, I had FICO's Score Watch. They're monitoring. I had multiple, actually, at the time. That first one that I got was FICO's. Some people, I'm in the minority among financial experts on this. Some people say, no, just get stagger your credit reports, or try to get a second credit report, because you can actually get a credit report for different reasons. Like if you're unemployed, if you've been rejected for credit, if you didn't get credit under the most favorable terms, you actually have a right to get an additional credit report. I like credit monitoring for the education that you get for it. You can see your own behavior and the instant results that it causes. Like, I rented a car with a debit card. I instantly had an inquiry. I instantly saw my credit score go down by 16 points. If you charge up, if I say, I want to go to Mexico, and I put the trip for $3,000 for the week on my credit card, I'm going to see the impact that has. If I pay off the $3,000 balance, I'm going to see instantly the change in my credit score. So I like it for that reason, and I encourage it. There are some places that offer essentially credit monitoring. I mentioned Credit Karma, another service that I've used and continue to use, and it is free. It's 100% free. So, you can, do a Google search for credit monitoring, but I think it's definitely worth it. Okay.
Close to what you were just talking about, when you say to pull your report regularly, what constitutes regularly? I know we have the annual credit report for free.
Okay, for at a minimum once a year. Obviously, you have the right to do that once every 12 months. Folks who are getting credit monitoring are typically looking at it whenever there's an alert. They'll find, they'll get something. But some will just log in and sort of see it. You can get once a month. Some of the credit cards that I mentioned before, the banks and whatnot that are offering it, they also are giving you either credit reports and or credit scores. So ideally, if you ask me, honestly, in a perfect world, I would like to see people looking at their credit reports quarterly. The ones who want to be aggressive about it, monthly. And if you really want to be like super aggressive about it because you have a goal, I want to buy a house in 6 months or a year, I want to make sure there's no problems, I would say have credit monitoring, even if temporarily, certainly, and look at it every single month.
Okay. Thank you, Lynette. I'm going to take 2 questions offline, and then we're going to move to that side of the room. Okay. And also remember that Lynette will be with us after the session is completed, signing books, as well as we'll go back over to the Welcome Center where we can have more interaction and more questions.
Sounds perfect.
So the first one offline is if you are just coming out of bankruptcy and poor mortgage debt, should you try for a national brand credit card?
No.
Okay.
No. So if you're just coming off bankruptcy and you have, what kind of mortgage debt did they say?
Poor mortgage debt.
Poor mortgage debt. Okay, so I don't know if poor mortgage means I haven't paid my mortgage or I got a subprime mortgage. I'm not exactly sure, but there's some problems there. So no, I wouldn't suggest that. But, here's the thing. A lot of people, they want the financial recovery to be, quick and easy, speedy. They want it to be overnight, even though they've had debt for 7 years. They've been in, it just doesn't work like that. I will say, though, that people who have gone through bankruptcy, people who have had mortgage problems, foreclosure, deed in lieu of foreclosure, short sales, a lot of the repair, a lot of the fixes, so to speak, the recovery period is less than people think. Like people think, oh, my credit's going to be shot for 7 years. No, it really won't be. Here's another factor in the credit scoring world. It's called recency. When the credit scorers of the world calculate that 3-digit number, it's really not for us. It's really for the financial community. It's really for prospective lenders in particular. They're just judging risk. They're telling through that 3-digit number how risky is this person, and over the next 2 years, how likely is this person to renege on their obligations? Are they extremely likely to pay and honor their debts and not have a delinquency, or are they very risky and they are likely over the next 24 months to default in some way? That recency factor also goes to the back end. So they'll look most closely at your most recent 2-year history. Yes, they're going to look back at the 7 years and all that, but most recent history matters. The person who had a 30-day late payment 2 months ago is deemed more risky than the person who had a 30-day late payment 2 years ago. So your most recent credit behavior is what is deemed to be most predictive. Because if you just had a bad mortgage problem or you just got out of bankruptcy, you have some proof. You got, as Ricky said to Lucy, you got some splaining to do, okay? You gotta show that, you're going to act right here and you're going to sort of get back on the road. So, no, I would focus on paying the bills on time for that person who has just come out of bankruptcy, and they likely don't have any credit card debts because they had to, they wiped them out and they got rid of those. So just focus on that.
Okay. Thank you for that. Now, there was one question online that I believe you've already covered, which was around, is the company that you've paid debt off with, are they supposed to contact the credit bureaus informing them that the debt has been paid? I believe you covered that. So we're going to move to this side of the room and take one question.
They're supposed to, but if you don't have it in writing, you might not get it. That's the short answer.
Absolutely. So let's take one last question. And then, as I said, we will make sure that Lynette is out front signing books, so she'll have more time for questions after we close, okay?
Thank you, Lynette, for
You're
all
welcome.
of your wonderful information that you've given us today. My one question is, okay, we're in credit repair mode. And I've had a long-standing credit card relationship with one lender. And would it be a negative impact if I reduce my credit line as opposed to keeping it where it is?
Probably. Again, remember that credit utilization ratio. It's a huge factor in that 30% of the score, how much debt you've charged. So if you're in credit repair mode, let's say you have one card with this long-established creditor, and let's say you have a $10,000 credit limit, and you're like, ooh, I don't want that temptation. Maybe that's the reason why. Is that common? People are like, I don't even want that. That's more about you than the credit card company, obviously. That's saying, I don't really feel comfortable with myself yet, so you may need to do something to put some safeguards in place so that you don't spend. But by reducing your credit line, yes, you're potentially going to, not potentially, you will impact your credit utilization rate. So if you say, you know what, slash it, make my credit line $5,000 instead of $10,000, and let's say you have $1,000 charged on there right now, I'm just making up numbers. Well, if you have a $5,000 credit limit, now you have a 20% credit utilization ratio. But if you have a $10,000 credit limit, you have a 10% credit utilization rate. But now let's say you took it to $2,000 from $10,000, and you have $1,000 charged on there. Well, you could have a very nice, healthy 10% credit utilization rate if you kept it at a $10,000 credit limit. But if you dropped it to, say, $2,000, now you got a 50%. So it's not helpful to you. You need to think about the other strategy, which is, how am I going to budget, have self-control, delayed gratification, spend wisely, and make a commitment to only charging what I can reasonably pay off every single month. That's really what it's about. Okay?
Thank you.
All righty. Thank you. Thank you.
You know that, well, first of all, we have to change our slide. It says previously featured on Oprah, Dr. Phil, Today Show. Now we have to add Dr. Oz, right?
And Steve Harvey. Add him on there,
And
too.
Steve, all right. Secondly, Lynn has books that you can take and read them and get much more in-depth information. And thirdly, this is what D-Free is about. You've heard this before, pay your bills on time.